In this video, we're going to be discussing the four option Greeks, delta, gamma, vega, theta, and how each one of them can affect an option's price. So before you take your next option trade, you might want to learn about each one of the Greeks and how it can help you pick the best option trade for you. So if you want to learn how this is done, stick around and let's go. Hey everyone, Lee Lowell here from smartoptionseller.com. So as I just said, we're going to be talking about the option Greeks and what each one is and how it affects option prices. You know, picking the right strike price for an option trade is really important, obviously, but knowing how the Greeks can affect that option price can help you make an even better decision on which option to trade. So we're going to go over each one. I'm going to show you the option calculators. I'm going to show you how the option prices can change based on various strike prices, based on various times of expiration. So you'll have a better understanding of how it works. So here we go. We have our usual cheat sheet here, and the four option Greeks are listed, the definitions of each, and then we'll bring up the option calculator. So delta to me is really the most important one for most retail option traders. You know, retail option traders are just people like you and me, where we're going in, we're picking calls and puts, and we're trying to, catch the direction of the stock. So the delta has a couple different meanings, but the most important one, I think, is the first one listed here, where delta, for those that don't know, okay, let's step back here for a second. Delta ranges from 0 to 100, and it's listed as a percentage. So it's 0% to 100%. What does that mean? So the delta of the option, each option has all four of these Greeks. So the delta of the option will tell you how much the option price will move in conjunction to the stock price moving. Okay, so let's just say you have a 50% delta. That means if the stock jumps $1 higher or lower, the option price is going to move about 50% of that. So if the stock moves $1, the option price will move about 50 cents per contract. If you have a 10% delta, so if the stock moves $1, that option price is going to move up or down 10 cents per contract. So if you're thinking about, buying an option or selling an option, and you want to understand, how the option price is going to move according to the stock move, looking at the delta is very important. Now, in my opinion, if you're going to be an option buyer, let's just say you're going to buy call options, which is a bullish type of strategy, you want your option price to move if the stock price moves, right? I mean, there's no point of buying an option contract, a call option contract in this case, if you're not going to get movement of it, right? So if the stock jumps, you want that option price to jump as well. So that means picking an option with a higher delta is going to get you more movement of the option price. A lot of people buy cheap options that have very low delta. So when the stock moves, the option doesn't move very far. People come to me and they say, Lee, I bought these call options, but the option price isn't moving. It's probably because they bought a very low delta option. So the delta will always tell you how much the option price can move or should move in accordance to the stock price. Very important. The second definition of delta, it'll tell you what are the chances or what's the percentage of that option contract that you purchased or sold is going to be in the money at expiration. Now, being in the money doesn't necessarily mean you're going to be profitable. In the money just means whether the option price is at a certain distance from the stock price. So if you bought a call option, the stock's at 100 and you bought a $90 call option and the stock finishes at 100 at expiration, that option's still in the money by $10. But you may have bought that option for $20 a contract way months ago, but now it's only worth $10 a contract. So even though the option's still in the money, you may have a losing trade. So just remember that. But use the delta for the first purpose, telling you how much the option price is going to move in conjunction with the stock price. So let's pull up the option. Let's pull up an option chain here, and I'll show you what that means. So this is the Interactive Brokers option chain right here. I usually bring this up in my videos. So we're looking at Disney, and we've been focusing on Disney the last few weeks here. Here's Disney, and the last price for Disney on Friday yesterday, April 28th, $102.70, $102.70. So we're looking at the July 23 expiration date, July 21st, 2023. Here's the strike prices down the middle. So if you do trade options and whatever broker you use, you want to make sure you have all the Greeks listed. Okay, here's delta, gamma, vega, theta, and these are the calls over here. And on the put side here, we also have delta, gamma, vega, theta. And the one thing I want to let you know is that the at-the-money options, which are the strike prices that are most closely related to the stock price, so in this case, it would be the $100 or the $105 strike prices. Those are considered at the money, okay? Those are the ones that are going to have, except for delta, the gamma, vega, theta. Those three, gamma, vega, theta, are going to have the highest level. And we're going to discuss each one of those in a second. But for right now, we're looking at delta. In this case, we'll look at the calls, okay? So let's just look at the 105 calls, which are, they went out around $4.85, $4.90 yesterday per contract. The delta, as at the money, are going to be very close to 50%. So the 105 calls have about a 49% delta. The 100 calls have about a 63% delta. So if you figure if there was a 102.5 strike, the delta would be somewhere between 49 and 63%. Okay, so what that means is that if Disney jumps, if you bought a call option, if Disney jumps from 102.70 to 103.70, that means the option price should jump about 50 cents per contract. Let's just focus on these 105 calls here. Let's just say we bought them for $4.90 per contract. Disney jumps up $1. That means these call options are going to be worth 50 cents more. So about $5.40 per contract is what the call option should be worth after Disney jumps. Okay, so the best way to think of delta is how much the option price will move when Disney moves. Now, if we scroll down here in the strike prices, now let's just say we're looking at this 150 call right here, which is worth about 4 cents a contract, and it has less than, a 1 delta. Sorry about all those things there. The 150 calls has less than a 1 delta, meaning if Disney jumps up $1, this option price may only go up to 5 cents a contract, 6 cents a contract, possibly. You're not getting any bang for your buck when you buy those cheapy options. So you're saying, Disney moved up $1. My option contract should move up a lot too. Not if you bought those cheapy 150 calls. They're only going to move up a penny. So you're not getting any option action out of that. So you want to stick to, if you're buying, in my opinion, if you want to get some movement out of your options, you got to stick to the strikes that have a higher delta. Yes, they're going to cost you more on a dollar basis. These 150 calls cost $5, but the 105 calls cost $490. So you have to decide how much do you want to spend versus how much movement you're going to get. All right, so let's go back to our cheat sheet here. Let's talk about theta for a second. Move myself over here. Theta signifies how much the option price will change due to the passage of time, all else being equal. That means if nothing else has changed, how much the option price will change in accordance to just turning the calendar over to the next day. Okay, this is what's called time decay. Every option as it moves towards expiration is going to lose a little bit of its value every single day just due to the sheer passage of time. That's just how options work, because once it reaches expiration, it won't exist anymore. So it has to shed a little bit of its value every day. And I use as an example, you think about an ice cube sitting out on the counter. You leave it out on the counter, it starts to shed its value, or it starts to melting over time until it's just a pool of water. That's how option contracts work. They start to shed a little bit of its value, its time value every single day. So if you're a buyer of options, let's just say you bought an option at $1 today, tomorrow it's going to possibly be worth 95 cents a contract. You lose 5 cents overnight just because we flipped the calendar over. So that's another reason why I'm a big proponent of option selling, because as an option seller, you sell something at a high price and you try to buy it back at a cheaper price. Well, time decay is just working automatically for you. That's the great thing about theta as an option seller. As an option buyer, the only way to get around losing that theta is for the stock to move. The stock has to move in your direction to offset the theta decay, the time decay. So if you're losing 5 cents overnight just because we flipped the calendar, you need to make sure that stock moves enough to offset that daily time decay. So a lot of people think they know where a stock's going to go in a very short period of time. And a lot of times they're wrong. The stock doesn't move in the right direction. So not only is the stock not moving in the right direction, but they're also losing to time decay. I'm talking about option buyers. All right, so let's look at theta here for a second. We'll go back to the option chain and we'll see. So in July, we're still sticking with these July options. The 105s, and we'll just concentrate on the calls here. The 105 calls have a theta of 3.9 cents. See, this is 0.039. That means 3.9 cents. So tomorrow, today they're worth, $4.90 a contract, which is 490 actual dollars. Well, tomorrow you're going to lose about 4 cents just because we flipped the calendar. So now it's going to be worth, $4.86 per contract. So you're holding on to something that's losing value every single day. And if Disney doesn't move, the stock doesn't move, you're not going to be able to offset that theta decay, that time decay. So you really have to think about that. And one thing I also want to show is that, so it's 3.9 cents is the theta today, but as you move shorter in expiration dates, let's go to the May 2023 expiration right here. So now we only have 20 days to expiration. You'll see the theta goes up. And once these numbers start to populate. So now the theta right here at the 105 calls is 8.5 cents a day. So if you buy a shorter expiration option, the theta goes up. That means you're going to lose even more money just by flipping the calendar to the next day. So in the July options, we were losing about 4 cents a day. Now we're losing about 8.5 cents a day. So once again, if you think you know where the stock's going to move in a short period of time, you also have to understand that if you're wrong as an option buyer, you're going to be losing more to theta decay each day, the shorter the expiration. So time decay really ramps up the shorter the expiration. So you have to understand it. So how do you get around it? Pick a longer term expiration date because you won't lose as much money to theta. Now, yes, it's going to cost you more by buying a longer expiration date. So here, the 105 calls are worth about $2.43. The July ones were worth $4.90. So $1.40 something, $2.40 something dollars versus 490. Yes, again, you're paying more for the option because you're giving yourself more time, but you're losing less to theta with a longer expiration. All right, so that's something else to think about. Deciding, how long you want your expiration date to be. Okay, so let's go back to the cheat sheet here. Number 3 on the list is Vega. Now, let me just back up to theta. So theta is moving all the time as well. As you can see, it's always changing. And like I said, based on the expiration dates, the theta gets higher. Vega signifies how much the option prices change when implied volatility rises or falls. Part of the option price baked into that is the volatility of the stock. So if the stock's really volatile, it's going to have a higher volatility component in the option price, means the option price will be higher. If a stock is very smooth and flatline, the volatility component of that option contract is going to be smaller and the option price will be smaller as well. So if volatility jumps up, the option price will jump up as well. So let's go back to the option chain. Once again, let's focus on the July options here. The 105 calls, the Vega is just about 20 cents per contract, 19.8 cents per contract. What does that mean? That means if volatility jumps up 1 percentage point, that means the option price can move up or down about 20 cents a contract. Now, in these option chains here, you can look right here where it says IV is 28%. Okay, that just means the implied volatility. That's what IV stands for. So based on a 28% volatility, these are what all the option contracts are worth. Okay, that's what their value is. Now, if volatility jumps from 28% to 29%, which is a pretty big move, these 105 calls will go up about 20 cents a contract. So instead of being worth $4.90 a contract, it'll be worth $5.10 a contract. So how do you use Vega? Why is Vega important? Well, you understand that when you're trading options around a stock's company's earnings announcement every 3 months, companies have earnings announcements. So what happens is that before earnings come out, the volatility starts to jump up because everyone's rushing in to buy calls or puts because they don't know how the stock's going to react after the earnings announcement. So people rush in. All this buying demand for calls and puts starts to push up the option price, which also pushes up the volatility level. And then once earnings come out, the volatility gets crushed. It's called volatility crush, and all the air is taken out. And once the volatility comes down, the option prices come down as well. So you have to understand how volatility is going to affect an option price. Now, a lot of people will try to buy straddles. That means buying a call and a put when volatility for a stock is very low. Volatility moves up and down as well. So a lot of people will try to buy volatility when it's cheaper for that specific stock. Stocks have a range for volatility, and a lot of people will try to buy volatility when it's cheaper on the cheap end of that stock's range. And so if you're right and the volatility jumps because there's a surprise announcement about something, then those option prices will move up as well. So that's how Vega works. So let's go back to our cheat sheet here. And also one thing, we'll look at Vega. Also, the at the money Vega is the highest for the at the money strikes. The Vega is the highest for the at the money strikes. And you'll see it's worth 19.8 cents here. Let's go to the May contract. And the Vega is going down. Okay, so as we get closer to expiration, a change in volatility will not help the option price move as much. You see it's only worth 9.4 cents here. The Julys are worth 19.8 cents, meaning that if you're banking on volatility to really help the option price, as you get closer to expiration, volatility is not going to affect the option as much. So once again, longer term options can help you if you're banking on volatility to move over time. If you bought a 1 week option because you think there's a company's going to have some kind of surprise announcement and it doesn't happen, the volatility change isn't going to help you. So once again, give yourself more time. Yes, it'll cost more, but you're giving yourself more of a chance for that stock to have that surprise announcement, and the option price will rally in accordance to how the Vega is. Okay, so let's go back to our cheat sheet. Last one, Gamma. Gamma will tell you. Now this is probably the least of the Greeks that you really need to worry yourself about. Okay, Gamma basically tells you how much the delta will move over time or in accordance to how a stock moves. So it's the speed of the delta. All right. So if you have a 50% delta or 50 delta and your gamma is X amount, that'll tell you how much the delta will move up or down based on where the stock moves. Okay. So we can once again go to the option chain here. Where's our gamma for the 105 calls? Also the highest when it's at the money. The gamma is the highest when we've got the close to the money options here. Let's scroll a little bit. So the 10, are we still in Disney? Yeah. Okay. So these Mays have dollars, strikes at every dollar. Okay. So we're looking at the 103s here. Really, the 102s and 103s have the highest gamma. So it's 4.8 cents. 4.8 percentage points, which means the delta is going to move by 4.8 points, higher or lower, based on how much the stock moves. Okay, $1 move in the stock. That's going to tell you how the delta will move. The gamma tells you how much the delta will move. So you really don't need to worry yourself about that as much. All right, so lastly, let's look at an option calculator. I want to show you how these things actually work, with real prices. So let's go to our, where's my options calculator here? And let it roll in. Okay, so this is at the optionseducation.org website. I've talked about this before, free option calculator. We're going to talk about, I want to show you how it works in real time. So let's just put in Disney. You type in the stock price, the stock, and it'll default to the last prices that were on the exchange at that time. So we're going to look at, let's just change this to 102.70, that's where Disney is in the option chain. We're going to look at the 105 strike, and we're going to look at the July options here, expiration, and we're going to change this to 28% to get all the numbers to match up pretty closely. We hit calculate, and this is what the call and put should be worth. So $4.83 for the call, $6.30 for the put. Let's go back to the option chain and see if that sort of matches up here. Disney for the July, and let's make sure we look at the 105s, and those are worth, when it populates, so $4.90, and this one's worth, the puts are worth, the bid ask, about $6.30. All right, so that pretty much matches up to what's going on in here. Now, the theta is 3.9 cents, which we saw in the option chain, 3.9 cents for the call. This is the call value right here. So let's just say we flip the calendar to 82 days left. And we're going to keep everything else the same. Day's expiration is 83 right now. So we're expecting this call value, $4.83, to drop by about 4 cents. So let's just say, $4.79 this thing should be worth tomorrow. So let's just change this to 82 days, and when we click on calculate, let's see what happens, right? See what happens? Now it's worth $4.79. So just because we changed the calendar to the next day, that call option just lost 4 cents per contract. That's 4 actual dollars for every contract that you have. All right, so that's how things work in real time. All right, all else being equal, if the stock stays at the same price for the next day, you're going to lose as an option buyer 4 cents per contract. All right, so I hope that makes sense to you. I hope you understand how these Greeks can be really important. Let's just bring up the cheat sheet one more time. Move myself over here. Make sure you understand the Greeks, because it'll help you to understand which is more of an ideal option strike and expiration date for you to choose. If you want to get the option to move when the stock moves, you got to get a higher delta, right? If you don't want to lose too much to time decay, then pick a longer expiration date. You're going to pay more for some of these options, but in the long run, it will help you out. Most people think they know where a stock's going to move in a very short period of time, and the stock market doesn't cooperate. So learn how to use these Greeks to your advantage to pick the right strike price. All right, so that's all as far as the lesson for today. Let's go over to our website, smartoptionseller.com. I want to make sure everyone gets a free copy of our Put Selling Basics ebook. Here at the Smart Option Seller, we're all about selling options and put selling. Selling put options is our bread and butter. I want to make sure everyone understands what that is. So go to our website, click on the Put Selling Basics header here, scroll down. You can read a little bit about it and put in your name and email address down here. We're going to send you an email with a link to download the free copy. Also, our services tab right here. We have a couple paid newsletters. We sell put options. We sell put option credit spreads. We have our one-on-one coaching sessions. And just announced last week, we have our Put Selling Intensive webinar that's coming up in May. So if you want to learn a little bit more about that, click on the Put Selling Intensive webinar. All right, so that's it for me today. I hope this has been helpful. I'm here to give you this free information to try to help up your options trading game. I've been in this business for 30 years. I know all this stuff. So use me, lean on me, let me help you. Send me an email, leave me a comment here. Don't forget to subscribe. Hit that red subscribe button. It helps the YouTube algorithm, and it helps them to show this video to more people. So don't forget to subscribe. All right. That's all for me today. I hope everyone has a great weekend and a great trading week ahead. This is Lee Lowell signing off.